Hello Sector Watchers, welcome to the show. This is the 81st episode of Sector Spotlight for Tuesday the 25th of May, recording it on Monday the 24th. My name is Julius de Kempenaer and I'm presenting the show to you from Amsterdam as usual. If you would like to get in touch, please use any of the handles on the screen. For today, we're going to go have a look at what happened last week in asset classes and stock sectors. Put that last week's rotation into a little bit longer term perspective on a weekly RRG, so we go from the daily to the weekly. And then there's actually one thing that I want to talk you through a little bit more in depth, and that's an article that I wrote, or the subject of an article that I wrote for the Chart Watchers newsletter last Saturday. And that's the difference between cap weighted and equal weight, and what it actually means when you chart equal weight sectors versus cap weighted sectors, and is what you're looking at actually equal weighted. Anyway, I thought it was interesting, and I'll try to dive a little bit more in depth into that subject later on in the show. Let's kick off with the rotation for asset classes. On the left-hand side, we have the daily RRG that shows you 5 days of rotation ending on Friday, May 21st. And if we look at the benchmark, that was down 0.1%, 10 basis points, so that's almost unchanged. And as you can see, the down was caused by a 30 pip decline in the stock market over last week. And we have high yields, treasuries and corporate bonds above, but only marginally. Corporate bonds were in line with the benchmark, treasuries were only marginally better, and so were corporate bonds. So that the whole benchmark that we're tracking here was sort of unchanged. Biggest outliers here, biggest differences I should say for the week was real estate with a gain of 80 basis points. And both commodity indexes with DJP down 1.2% and GSG down 1.6%. But as you can see, they're still far on the right hand side of the graph. And so far, at this point in time, I think that is a corrective move within the longer term strength that we've been seeing and been calling for commodities here. If we look at the RRG, and let's just move the commodities out of the way, then you see a little bit of, it's moving upward on momentum but downward on relative strength, and that all in all is still not a very good sign. So that was, stock market continued to weaken, bond ETFs, bond markets continue to improve but lose momentum. So it sort of reflects the unchanged character of the benchmark, and in those four asset classes, stocks and then corporate, governments and high yield. All in all, not a massive change in that 5-day period. If we bring that over to the right hand side and we look at the same universe on a weekly scale, then we have to conclude that stocks are still the preferred asset class. They're far away on the right. Bonds, government bonds are on the left. They're picking up a little bit, but far to the left. And high yield and corporates are, corporates are moving in line. High yield is sort of unchanged and circling around 100 on the RS momentum scale with a very short tail. So that means a stable relative downtrend. And here also we see some weakness for commodities, DJP and GSG. Continue to lose relative momentum. But all in all, they are the stronger asset class in this whole universe, together with ITOT. How long that will remain like this, I don't know. We'll have to see. But at this point in time, ITOT is still far to the right of bonds, and commodities far to the right of the benchmark. Although they're not part of the benchmark, they're definitely a source of alpha versus VBINX. Let's have a quick look at the price charts for stocks. ITOT is the ETF that I'm using for that, for the broader market, because it covers the total US stock market. The uptrend here is clearly intact. The last bar market has just closed on Monday, so that last little bar here is this today's session. And what you see is that we have touched the lower boundary of that rising channel, and we came off that support level last week, moving higher. So we're still inside that rising channel. If you look at the relative strength, and especially the trend in that relative strength, then that is also still going, although the last few weeks we are moving sideways. And you see that when you draw the RRG lines on that trend, on that ratio of ITOT versus VBINX, that it has been stable basically for all of this year, and momentum is slowing down. It's around 100, it's a little bit below 100, and relative strength RS ratio is sort of flat and maybe starting to roll over. That's what you see here on the RRG, where ITOT is moving into the weakening quadrant. It's a stable trend. It's still up, but it's losing strength, or at least it's losing its upside power. It's losing its upside momentum. And that is something that we do need to take into account when we build our puzzle, when we will build our opinion on the market as a whole. If we move to GOVT, to the government bonds, then we're looking at this chart here. I have this little correction flag type pattern drawn in here for quite some time already. It's still there. It's not executed. It's not broken. If we get out of that little consolidation pattern, I do think that this government bond ETF will drop further. That means pushing yields higher, and usually that's not good for stocks. If you look at the relative strength of GOVT versus VBINX, then it looks as if it's sort of bottoming, and we can actually compare that with what we saw here on ITOT. That's, can I call it, like, it's getting tired, and then when you see GOVT here, it's losing its downward pressure. So it's sort of the reverse of what we see in the stock market. The only thing is that you need to keep in mind, this is relative strength, and it's relative strength versus VBINX, and VBINX is 60% stocks and 40% bonds. Now, if this drops, if this executes and drops and pulls GOVT lower, pushing yields higher, one would think that that would be not such good news for stocks, which would slow down stocks. But be aware that all of that can happen, and we can still see relative strength of GOVT versus VBINX, or GOVT via the stock market, improve, because when this really executes and we're really in for a larger corrective move, then GOVT will simply drop less fast than the stock market, causing relative strength for bonds to pick up versus stocks. We're not there yet, but I'm just putting it out here as a warning, because the relative line of government bonds is sort of flattening out, and the relative line for stocks is flattening out, and that is usually where you see the turnarounds. So I want you to be aware of it. I'm aware of it. I'm watching this like a hawk, because if that happens, that could be the bigger turnaround, that we're signaling that we're going into a bigger type of correction than we have seen so far. Anyway, that was my word of caution. If we bring up the relationship of ITOT versus GOVT, then we see this very nice looking uptrend that is still fully intact and not broken yet. If we see this breaking, this is the ratio of stocks versus bonds. If we see this breaking, then we're in a lot more trouble. But be aware, the underlying charts of ITOT and GOVT versus VBINX are sort of giving us a warning signal. They've done it before. We can see a reversal back. We can see ITOT rotating back to leading, and we can see GOVT, rotating back to lagging. And if that happens, that's all fine. Then we'll just track that move, we'll track that rotation and position ourselves accordingly. But right now, just be aware of the fact that there is some underlying weakness for stocks. If we bring up the RRG, the daily RRG for last week covering US sectors, then we can see that the S&P lost 40 bips, 40 basis points, and the strongest sectors, the one with positive returns in absolute terms, were technology, staples, utilities, healthcare, and real estate. And it's interesting that healthcare, utilities, staples are all the defensive type sectors, and then we have technology and communication services as more cyclical, offensive type sectors. So it's a bit of a mixed bag. It's not all out offense or all out defense, or at least not throughout last week. We look at the individual rotations, then real estate was at the top. We see a nice rotation from weakening back into leading, which is encouraging for the real estate sector. We look at healthcare, that's at a very short tail, losing a little bit of relative strength versus the benchmark, but still comfortably inside the leading quadrant. Utilities making a sort of a hook here. Now definitely heading towards the leading quadrant. Staples inside leading, losing a little bit of momentum. Technology, probably the, if you look at the individual tails on this chart, just isolated, and this is the strongest tail. Relatively long, moving from lagging rapidly into improving. Although it is still at the lowest level together with discretionary of the universe on the RS ratio scale. So relative downtrend at the short term, but it's picking up, or maybe it's losing its downforce. Maybe let's put it like that. We go to financials, inside leading, loss of relative momentum together with materials and energy. These are all pretty vertical moves. So far, these are still strong sectors in terms of relative strength. They're going through some sort of a correction, and that's why they're dropping on the vertical axis. And then we have industrials that has already, it's pretty similar rotation. It's already dropped into the weakening quadrant. If we move over to the weekly version, then we see that especially here, utilities, staples, healthcare, those are the defensive sectors, and they're all pointing towards the northeast. That's strong. They've got a positive RRG heading, strong RRG heading. And if you look at the rest of the sectors, that's a bit of a mixed bag. Technology, the strength that we saw on the daily translates into a little hiccup on the weekly RRG. And we've seen the same for discretionary, but it has not managed to pick up. Well, neither of those sectors have managed to pick up relative strength on the weekly scale. So they remain worrisome. We need caution. These are important sectors. They're inside the lagging quadrant, and they're not able to pick up relative strength versus the S&P 500. That makes me cautious. We do need those sectors for a strong market as a whole. If you look at the others here, energy, financials, communication services, going through corrective rotations well into the weakening quadrant right now. Although energy and financials were the strongest, are still the strongest at the top of the list here when you look back over a 5-week period. We'll have to see how that tracks out. We do have defensive sort of dominating the improving quadrant, and a mixed bag for all the others. So for the time being, I keep my cautious stance based on the current sector rotation. Let's have a look at the price charts of a few of those sectors in combination with the weekly RRG that's now on the left. If we start with utilities, it's the one here pushing into the improving quadrant at a relatively long tail. And you see the move here of the RRG lines that is causing that tail to push into that northeastern direction. We're getting into maybe a little bit of a trouble zone here because we have this falling resistance connecting the last few major highs in the ratio chart. You see the flat move that is already in play since, when was that? February, mid-February. The ratio line of utilities versus the S&P 500 was almost flat. It was flat. And that's causing the momentum to pick up, to turn around, because it was down first and now it's starting to turn around, starting to pick up relative strength. We need to still break that resistance, but things are improving on a relative basis. And that is helped by the fact that utilities managed to get back into its old rising channel. We ran into resistance around 68, but the good news is that last week and the week before we tested the bottom of this rising channel. If utilities can break above 68, then the next level is the former high around 71, and that will certainly improve relative strength and push that tail higher. So that's the story for utilities. If we look at the staples tail, that has a similar trajectory, but it's leveling off a little bit. Bring up the chart here, then we see that we're still comfortably above the breakout level. But what I'm watching here is the consolidation in terms of relative strength, sort of the double bottom formation that's working out. We do need to break above this relative high here that was set in March, in the week of the 22nd of March. If we manage to push above that high, then we're completing this double bottom and we can push to levels that we've seen at the end of 2020 and pushing the RRG lines back above 100 and this tail into the leading quadrant. We do need to pick up momentum relatively soon now, I should say. The third sector here in this improving quadrant is healthcare. And if we see that, that's the steepest one. So it's just inside that 0 to 90 degree heading. If we bring up that chart for healthcare, then we see that it is pushing against the top of its rising channel on the price chart. That's a good thing. If we break beyond that rising resistance, that's usually a trigger for acceleration. But from a relative point of view, this chart here is more interesting. We are pushing against resistance, and it's a sort of double, triple resistance area. We've got the horizontal level here from these lows. We have another horizontal level here that we are about to break right now, and we're pushing against the falling resistance line. It's the second attempt. You see that we had this hiccup before in the RRG lines, and we're doing it again now. RS momentum already above 100, starting to pull RS ratio up. If we break above, and let's put this at 0.3 in the ratio of healthcare versus SPY, and we can at least maintain these levels in price, but preferably break higher, then I think we can see an acceleration in the healthcare sector, and that will pull the tail for XLV into the leading quadrant. Now, these are all three are defensive sectors, with healthcare being the most important one. So that's sort of backing up my story about defense leading the charge at the moment. Although you may not see it in the market as a whole, under the hood you see three major defensive sectors inside improving and pushing at a strong heading, and the fourth defensive sector is energy, but that's actually already inside or at the right hand side of the plot, went through a very strong rotation inside through leading, is now in weakening, but has plenty of room to rotate back up. As a matter of fact, it's the strongest sector in terms of relative strength ratio. So we've got the four defensive sectors in the market at a positive trail and at a positive relative uptrend. I think that tells you something. And especially when we bring up the charts for technology and discretionary. Let's start with technology. Last week's rotation improved the chart slightly, I think. We bounced off that rising support line, so that's good. Can't say anything about that. But I'm still worried about that relative strength, about that ratio line. That's definitely showing a series of lower highs and lower lows. There is a lot of resistance overhead for this one here. And if you look at the RRG lines, RS ratio below 100, RS momentum below 100, picking up a little bit. And that's why you see technology, let me highlight that here for you, is picking up a little bit. The question is, can we actually hold up? And if I look at that relative trend here, and I'm serious in doubt, I am not convinced that this is the end of the corrective move inside technology. If it is, I'd be very happy because it means good news for the stock market. But in all honesty, I do need to see a lot more improvement, especially in the relative strength department, before I would dare to call this a relative uptrend again. Now, last week's show was called Danger from Discretionary, and it looks as if the danger is indeed coming from the discretionary sector, because this was last week, and this is today. This is basically Monday, so you saw that last week we already started to move a little bit to the left, and that's continuing into today. But if we bring the chart for XLY, then things become very, very clear very, very rapidly. We're at the bottom of the rising channel, managed to hold up so far, but not a real nice bounce like in the technology sector. But what is really worrisome is that we're breaking below the previous low in relative strength. And that is something that I think we need to be very, very aware of, because this is a weak sign. And you already see the effect on the RRG lines, where RS momentum seems to be putting in a new peak against 100, and it's already starting to drag RS ratio line down again. And you can see that happening here in the RRG, where you see that sort of hooking back to the left. All in all, from a sector perspective, sector rotation perspective, I remain very, very cautious with the market as a whole. I know we have some good days, but the underlying trends, the underlying rotations, still keep me on the edge, keep me on my toes, keep me on the tip of my seat, because I see strength in defensive sectors, and that is something that you do not want to see when you're about to see a very strong market as a whole. In the last bit of the show, I want to point your attention to the article that I wrote last week for the Chart Watchers newsletter. And that has everything to do with the comparison between cap-weighted and sector and equal-weighted indexes and sector indexes. We all know that some of the cap-weighted sectors are dominated by one or a few mega-cap stocks. We've got Apple in information technology, we got Facebook and Google in communication services, we have Amazon and Tesla in consumer discretionary. So these sectors are heavily influenced by the movements in these stocks. The solution, or where a lot of people turn to, is to move to equal weight sectors or equal weight indexes. And Invesco provides a family of ETFs that covers the S&P sectors, the same as we're always using here, provided by Spiders, by S&P Spiders by State Street. We can use the Invesco set of equal weight sector indexes. And you can actually find all the information about these indexes on the Invesco website. You just punch in the ticker symbol or the name of the sector, and you'll find a fact sheet that holds all the information about these sector ETFs. And if we start with the consumer discretionary ETF, RCD, obviously that's an important one because of the impact of Amazon. This one has 63 names in it, 63 stocks inside the consumer discretionary sector, and therefore also in this ETF. Now, when you take 100% of this sector and divide it by 63, you come out at 1.6%. So at the start of every quarter, all these indexes are rebalanced at the start of the quarter. They will be at 1.6%. If you currently look at the current weightings, you will see that they have shifted. The top one here, pool, is at almost 2%, while if we scroll all the way down, you'll see that Under Armour is at 0.7%. That is because of the movement that has taken place since the rebalancing. But we have 63 names at 1.6% each. If we go to the utility sector, so we have here RYU, which is the equal weight utilities ETF, and where you want to go to is the portfolio and the composition, and you can look at the holdings, and you can even, if you click view all, you see all the holdings, and you can even download them to an Excel sheet. And you will see that because it has only 28 constituents, every constituent is weighted at 3.6%, and obviously this is also shifted after the rebalancing. Now, if we do that for the S&P 500, for RSP, then you will find that because RSP, the S&P at the moment has 506 constituents, so 100 divided by 506 is 0.2%. So every member of the S&P 500 is weighted at 0.2% at the rebalancing. So there's no dominance in the S&P either. However, we've already seen just that consumer discretionary has 63 names, utilities has only 28. In the S&P 500, every stock is at 0.2%. So what happens when you look at RSP from a sector perspective? In RSP, every stock is equal weight. But if you go at a sector level, that's not equal weight anymore, because there is a different number of holdings in every sector. So industrials actually comes out as the largest sector in the equal weight version at 15%, because it has so many names in it. Information technology comes at 14.6%, and our consumer discretionary comes out at almost 12%, and you can see that communication services is only 4%. It's one of those very subtle, and you probably know it when you think about it, but I have to admit that I didn't think about it thoroughly enough, not always. And then you realize it, that when you look at that equal weight sector RRG, that benchmark is not at a sector level equal weighted. So every single sector is equal weighted, but not inside the benchmark. And that's something that can have some subtle, very subtle differences. And I think that's one of these things that you need to be aware of when you start studying sectors, sector work, and compare cap weighted with equal weighted. Because one of the things that came out is that consumer discretionary in both cap weighted and equal weighted comes out at 12% at a sector level. All right, the one is without the dominance of Amazon, but still, they're similar, while the other ones can shift massively. This was Sector Spotlight for this week. Thank you very much for watching. Give us a thumbs if you like the show. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern here on StockCharts TV. And I sure hope to see you back next week at a new episode of Sector Spotlight.